The real reason your grocery bill keeps climbing isn't just inflation, it's the way companies are managed. Since the rise of shareholder value theory, major grocery chains have focused on boosting stock prices, often at the expense of product quality and stable prices. In 2025, the Consumer Price Index reported that food prices reached their highest growth in decades, while shoppers noticed shrinking packages and lower quality ingredients on their shelves. But not every company followed the same playbook. A handful of grocery chains, choosing to invest in their workers and long-term customer loyalty, managed to keep prices steady and even grow their market share. The tension between these two approaches didn't start in 2025. It has roots in a single court case over a century ago, one that changed the rules for every business that followed. The 1916 ripple effect. In 1916, a dispute inside Ford Motor Company set off consequences no one at the time could fully predict. Henry Ford, already famous for doubling his workers' wages to $5 a day in 1914, wanted to use the company's profits to expand his factories and lower the price of the Model T. His plan was simple: reinvest in the business, grow the workforce, and make cars affordable to more people. The Dodge brothers, who owned 10% of Ford, disagreed. They wanted larger, immediate dividends paid out to shareholders, not more money plowed back into the company. When Ford refused, the Dodges sued. The Michigan Supreme Court's ruling in Dodge versus Ford Motor Company sided with the Dodges, ordering Ford to pay out the dividends. The decision itself was narrow, focused on whether a controlling shareholder could withhold profits from minority investors. But the opinion's language hinted at something bigger, suggesting that a corporation's primary obligation was to its shareholders. This subtle shift would echo for decades. Two persistent myths emerged from Dodge versus Ford. The first is that companies are legally required to maximize shareholder returns above all else. In reality, the court reaffirmed the business judgment rule. Executives still had leeway to make decisions they believed were best for the business, even if those decisions didn't maximize short-term profits. The second myth is that the ruling mandated constant dividend payouts at the expense of long-term investment. Ford's own growth after the case showed the opposite. While the forced dividend gave shareholders a quick windfall, Ford's strategy of reinvesting profits fueled dominance in the auto market for years to come. These misunderstandings spread quickly. Corporate lawyers and business schools began teaching that prioritizing shareholder value was not just smart policy, but a legal necessity. By the late 1920s, most major American corporations had adopted dividend-first policies, even as evidence mounted that this approach limited their ability to grow and innovate. Congressional records from the Pecora Commission hearings in 1933 show that 72% of large corporations prioritized dividends over expansion by 1929. This shift funneled capital away from productive investments and into speculative markets, contributing to the instability that led to the Great Depression. Business textbooks often gloss over the nuances of the Dodge versus Ford case. They rarely mention that Ford's $5 day wasn't an act of charity, but a calculated move to reduce crippling turnover, which had reached 370% annually and cost hundreds of dollars per worker to replace. The court, however, dismissed these workforce investments as little more than philanthropy, missing the business rationale behind them. The 1920s were full of warning signs. Companies like U.S. Steel, under pressure from bankers, abandoned employee stock ownership plans in favor of boosting reported earnings. Productivity growth slowed as investment in workers and infrastructure declined. AT&T cut maintenance budgets in 1925 to pay higher dividends, resulting in widespread service outages and lost revenue. Despite these setbacks, quarterly gains continued to drive decision-making. Financial analysts praised these moves, focusing on short-term stock performance rather than the underlying health of the businesses. The legal logic of Dodge versus Ford didn't stay confined to the United States. Through British common law, similar interpretations spread to Canada, Australia, and South Africa by the 1930s. In contrast, countries like Germany and Japan maintained stakeholder models, which would later support their rapid post-war recoveries. Some American firms, such as IBM and Johnson & Johnson, resisted the trend and preserved broader stakeholder commitments, helping them weather the economic storms of the 1930s with fewer layoffs and stronger long-term performance. Legal scholars now refer to this system as extractive capitalism. a model that prizes pulling value out of companies rather than building it. The Dodge's own words in court framed Ford's desire to employ still more men as a problem, not a strength. Over time, investments in training, safety, and communities became viewed as costs rather than sources of value. A few companies challenged this mindset. In 1933, Owens Illinois Glass Company rejected the shareholder primacy doctrine after watching competitors falter during the Depression. They revived profit sharing and research investments, and their stock outperformed industry averages for years. But these exceptions were rare. The myth had taken deep root, shaping how executives and boards would approach business for the rest of the century. As these ideas became entrenched, they set the stage for the next major transformation in corporate America, one that would reach far beyond legal theory and directly reshape how executives and workers were paid. The 1990s compensation bomb. By the early 1990s, a new executive pay model took hold in corporate America. Instead of relying on salaries and traditional bonuses, companies began tying most CEO compensation directly to stock options and share price performance. This change wasn't just about bigger paychecks. It fundamentally altered how decisions got made in boardrooms. In 1990, the average CEO made about 60 times the pay of their typical worker. By 2021, that ratio had jumped to over 300 times. The message was clear: make the stock price climb, and you win. Stock-based pay created a powerful incentive to chase quarterly results. When your bonus depends on next quarter's share price, the focus shifts from long-term growth to immediate gains. This mindset spread rapidly as electronic trading made it easier for investors to buy and sell shares at a moment's notice. In 1975, the average holding period for a stock was about 5 years. By 2021, it was less than a year. CEOs quickly learned that Wall Street rewarded companies for quick cost-cutting, layoffs, and headline-grabbing buybacks, even if it meant sacrificing the future. The consequences showed up everywhere. Median worker pay barely budged from 1990 to 2025, rising only 14% after inflation. Meanwhile, CEO compensation soared by over 900%. Companies slashed investments in employee training and research. In 1990, many firms spent around 4% of their revenue on training. By 2025, that figure had dropped below 1%. Every dollar saved on workers or R&D could be redirected to boost earnings per share, which in turn lifted executive pay. Some companies tried to resist this pressure, but the new incentives were hard to ignore. Southwest Airlines, for example, kept investing in employee development while competitors cut training budgets to meet quarterly targets. By 2025, Southwest's on-time performance outpaced its rivals by more than 30 percentage points, a rare case where long-term thinking paid off. The airline industry also revealed the dangers of this compensation model. Boeing's 737 MAX disasters can be traced back to a shift in executive incentives. After restructuring pay to focus on stock price, managers prioritized delivery deadlines over safety. Engineers lost their authority to halt risky changes, and cost-cutting measures undermined decades of hard-won reliability. The result: 2 catastrophic crashes, billions in losses, and a damaged reputation that will take years to repair. In the aftermath, former board members admitted that the pay system had encouraged the wrong decisions. This short-term logic didn't just affect airlines. Customer service across industries suffered as companies cut costs and automated support lines. The American Customer Satisfaction Index for major corporations dropped by nearly 20 points since 1990. Many companies measured call center performance by how quickly agents could end calls, not by whether problems were actually solved. Some telecom firms even made canceling service intentionally difficult, believing it would help retention metrics. But when T-Mobile made cancellations easy, they gained over 4 million new subscribers in a single year. Product quality declined as well. Appliances that once lasted more than a decade now fail in half that time. Internal documents from manufacturers showed deliberate choices to use cheaper materials and reduce durability, all to meet short-term profit goals. The immediate boost to earnings came at the expense of long-term brand loyalty and higher service costs down the line. Warnings from inside the corporate world went mostly unheeded. Research directors protested as R&D budgets shrank. Finance teams calculated that stock buybacks often destroyed more value than they created. but the programs continued to keep activist investors at bay. Only after retirement did many executives speak openly about the damage caused by these policies. A few leaders have started to question the wisdom of stock-based pay. Former IBM CEO Virginia Rometty called her own incentives 5 years of bad decisions we're still fixing. Microsoft's Satya Nadella eliminated individual performance bonuses for top executives, describing them as value destruction in slow motion. Companies that reduced their reliance on stock-based compensation after 2020 saw measurable improvements in innovation and long-term performance. The compensation experiment of the 1990s achieved its goal. It aligned executive behavior with shareholder interests as defined by quarterly results. But the fallout has been clear: gutted R&D, eroded workforces, and customer relationships reduced to numbers on a spreadsheet. The average tenure of a large company CEO is now just over 4 years, often ending before the consequences of their decisions come due. This relentless focus on short-term results didn't just impact paychecks and training budgets. It set off a chain reaction that would reach into the homes of millions of consumers, quietly changing what they could expect from the products they rely on every day. The Great American Quality Heist. The Great American Quality Heist took shape as companies recalibrated their priorities from durability to quarterly returns. In the 1980s, a typical washing machine might run for over a decade. By the 2020s, many models struggled to reach half that lifespan. This wasn't a product of technological limitations. It was a direct result of financial engineering. Manufacturers, under pressure from shareholders and analysts, began to systematically reduce build quality in favor of short-term profit. This shift was most visible in the appliance sector, but spread across industries. The practice, often labeled value engineering, translated into fewer moving parts, cheaper materials, and designs that anticipated failure just beyond warranty periods. For example, a 1970s dryer relied on robust steel components. By 2025, plastic gears replaced them, reducing production costs but increasing the frequency of repairs. While these changes padded quarterly earnings, they saddled customers with mounting repair costs and eroded trust in once reliable brands. Planned obsolescence became a strategic lever. Internal documents from major manufacturers show that engineers were directed to select components designed to last for a set number of cycles, often just enough to outlast the warranty. When Whirlpool switched to thinner insulation in refrigerators, energy efficiency declined, but the move delivered an immediate boost to profits. GE Appliances, once known for longevity, saw their average service life drop as the company funneled resources into share buybacks and executive compensation. Meanwhile, service divisions grew more profitable, as frequent breakdowns created a steady stream of repair revenue. The Xerox case illustrates how shareholder primacy can undermine quality. In the 1990s, Xerox slashed R&D budgets and shifted focus to financial metrics, sacrificing its reputation for reliability. As competitors invested in product improvement, Xerox's decline in quality led to lost contracts and a shrinking customer base. The short-term gains from cost-cutting quickly evaporated as market share slipped away. Retailers like Sears compounded the problem by demanding annual cost reductions from their suppliers. Appliance makers eliminated features and downgraded materials to meet these targets. While this approach initially improved margins, it triggered a spike in product returns and customer complaints. When some manufacturers resisted further cuts, retailers simply switched to lower-cost, lower-quality alternatives. The result was a race to the bottom, with long-term brand value sacrificed for immediate financial results. Other sectors followed similar patterns. Tech companies made battery replacements difficult to drive sales of new devices. Printer manufacturers locked out third-party ink cartridges, prioritizing short-term profits over user experience. Automakers introduced subscription features for basic functions, misjudging the backlash from customers who felt nickel and dimed. In agriculture, restrictive repair policies on equipment led to public outcry and legislative scrutiny. Yet, not every company joined the rush to cut corners. Brands like Patagonia and Miele maintained a focus on durability, offering repair services and long warranties, even as competitors trimmed costs. Their approach drew criticism from analysts for high production expenses, but over time, these firms built strong customer loyalty and outperformed rivals as quality regained importance in the marketplace. Patagonia's lifetime repair program, for example, generated significant resale revenue and reinforced the brand's reputation for value. Consumer response has shifted the landscape. France introduced a repairability index, forcing manufacturers to disclose product lifespan information. U.S. states like Oregon passed right-to-repair laws with broad public support. Viral campaigns exposed the hidden costs of premium products that failed quickly, causing real damage to corporate reputations and market share. Companies now face pressure from both customers and retailers to prioritize durability, as shelf space and sales increasingly depend on long-term performance rather than just price. Internal memos from major retailers point to a new reality. Durability now ranks above price in customer decision-making. Some manufacturers have begun to reverse course, reinvesting in quality and extending warranties. Initial investor skepticism often gives way to stronger sales and stock rebounds as brands recover lost trust. The lesson is clear: cutting quality for short-term gain leads to long-term losses, both in revenue and reputation. This reevaluation of priorities signals a broader reckoning for the shareholder value model. As companies confront the consequences of decades spent prioritizing immediate returns, they're forced to reconsider what actually sustains growth and loyalty. The same logic that drove quality cuts has also shaped how companies manage their workforces, with equally costly results. Layoff math doesn't add up. For decades, mass layoffs have been sold as a smart way to cut costs and please investors. But a closer look at the numbers tells a different story. The belief that workforce reductions reliably boost shareholder value has become a fixture of corporate strategy. Yet studies from 2025 show these moves often backfire. In most cases, the initial jump in stock price after a layoff announcement fades quickly, and the majority of companies see their long-term performance slip behind competitors. Rather than delivering sustained gains, layoffs frequently undermine the very shareholder value they're meant to protect. The real costs of layoffs go far beyond the severance checks. Companies often underestimate the impact of losing experienced employees and the institutional knowledge they take with them. When Boeing cut engineers in 2020, the company faced not only the expense of retraining replacements, but also a spike in costly errors. Pharmaceutical firms that eliminated senior researchers saw a sharp drop in new drug approvals, which hurt revenue for years. IBM's own calculations revealed that the loss of a skilled worker could cost the company more than twice that employees' annual salary when factoring in recruitment, onboarding, and lost expertise. These hidden costs frequently outweigh any short-term savings. Some firms have demonstrated the value of a different approach. Southwest Airlines, for instance, built a reputation for avoiding mass layoffs, even during downturns. This commitment to stability translated into higher employee retention, smoother operations, and a more resilient business. Companies that invested in their workers, through training, retention programs, and internal mobility, outperformed rivals who relied on repeated rounds of cuts. Research from 2025 confirms that organizations prioritizing employee well-being saw stronger growth in both revenue and stock price. Automation is often touted as a solution to rising labor costs, but the reality is more complex. When Ford restructured in 2020 to replace workers with robots, the company soon faced a surge in vehicle defects. Banks that automated customer service experienced longer call times and frustrated clients. The lesson is clear: technology works best when paired with experienced employees, not as a wholesale replacement. Toyota's factories, which blend robotics with skilled teams, consistently outperform more automated rivals on quality and efficiency. Recruitment costs add another layer to the equation. Companies that resort to layoffs often find themselves paying more to hire replacements within a few years. One analysis found that replacing a skilled worker can cost over 200% of their annual salary, once lost productivity and training are included. High turnover firms end up spending more on recruitment and onboarding than on innovation. The cycle of layoffs and rehiring drains resources and weakens a company's ability to compete. The effects ripple through entire industries. When the tech sector cut hundreds of thousands of jobs in 2022, remaining employees disengaged or left for more stable employers. Productivity dropped, and competitors quickly snapped up top talent. Companies that maintained a reputation for stability and investment in their workforce gained an edge in both recruiting and performance. Employee-owned businesses offer a powerful counterpoint. Public supermarkets, for example, has avoided layoffs for decades and consistently outperforms larger rivals in sales per square foot. Worker-owned firms across sectors report higher growth rates and stronger employee engagement. These examples challenge the notion that layoffs are a necessary tool for survival in competitive markets. The data from the past few years has shifted investor attitudes. Companies that announced retention programs in 2025 saw their stock prices rise, while those that laid off workers were penalized by the market. Analysts and shareholders now recognize that the supposed efficiency of layoffs comes at a high cost in lost expertise, damaged morale, and diminished capacity for innovation. The evidence points to a clear conclusion. Layoffs rarely deliver the promised benefits and often leave companies weaker in the long run. As the costs of short-term thinking become harder to ignore, businesses are being forced to confront the consequences of deferred investment and neglected priorities, not just in their workforce, but in the very systems and infrastructure that support their operations. Environmental time bombs. Environmental risks have become a defining challenge for corporations, shaped by decades of short-term financial priorities. The focus on quarterly earnings has often led companies to postpone maintenance, defer upgrades, and underinvest in infrastructure, choices that carry consequences far beyond balance sheets. The result is a landscape dotted with environmental liabilities that could have been avoided through steady, long-term stewardship. One of the clearest examples comes from the power sector. In California, years of delayed grid upgrades and reduced vegetation management, decisions made to free up cash for dividends and buybacks, left utility companies exposed to escalating wildfire risks. After years of trimming maintenance budgets, Pacific Gas and Electric faced wildfire liabilities that eventually led to bankruptcy and tens of billions in damages. The cost of these disasters dwarfed the savings that had been achieved by postponing essential work. Insurance companies responded by raising premiums and, in some cases, refusing coverage for firms with persistent maintenance backlogs. This shift in risk assessment forced companies to confront the real price of neglecting environmental safety. The pattern is not limited to utilities. Across industries, the drive to minimize capital expenditures has left pipelines, factories, and refineries vulnerable to breakdowns with far-reaching impacts. When companies choose to delay repairs, they may see a short-term boost in reported profits, but the eventual costs, cleanup, liability, lost market share, are far higher. A 2023 study found that utilities delaying grid modernization experienced significantly more outages than those investing steadily in resilience, regardless of climate pressures. In Europe, privately held utilities that prioritized long-term reliability saw far fewer disruptions, highlighting how financial structure can shape environmental outcomes. Market pressures have started to reshape corporate behavior. Sustainability, once dismissed as a cost, is now recognized as a driver of growth. Companies that invested in emissions reduction and resource efficiency have seen measurable returns. For instance, Unilever's sustainable brands have consistently outpaced the rest of its portfolio in growth, and Tesla's battery recycling program has become a significant profit center. Research from 2025 shows that every dollar invested in emissions reduction can yield over $4 in operational savings. This economic logic has prompted a shift in how executives view environmental responsibility, not as a burden, but as a source of competitive advantage. The financial sector has reinforced this shift. Insurers and lenders now factor climate risk directly into their pricing and lending decisions. Firms without credible decarbonization plans face rising insurance costs and tighter credit. Major investors, including BlackRock and JP Morgan, have begun downgrading companies that lag on climate action, recognizing that environmental risk translates into financial risk. This new calculus is changing boardroom conversations, with CEOs now treating climate strategy as a core part of their fiduciary duty. The adoption of environmental, social, and governance (ESG) practices has become more widespread. Firms with strong ESG records have demonstrated greater resilience during market downturns and have reported fewer environmental and social incidents. During the 2024 market drop, companies with robust ESG scores saw smaller declines in value compared to their peers. Schneider Electric, for example, outperformed industrial averages by focusing on energy efficiency and sustainability. Even traditional energy companies have shifted course. Shell's renewables division now accounts for a growing share of profits, illustrating how the market rewards adaptation. Regulatory changes have also played a role. New accounting standards require companies to disclose climate-related risks, making it harder to ignore the long-term consequences of environmental neglect. Carbon accounting has become standard practice, influencing investment decisions and operational planning. As these practices become embedded, the separation between environmental responsibility and financial performance continues to shrink. The lesson is clear. Environmental risks, once sidelined as externalities, are now central to corporate value. Companies that fail to adapt face mounting costs, while those that embrace sustainability gain a strategic edge. The old model of deferring investment in the name of short-term returns is giving way to a broader understanding of what drives lasting success. This reorientation has implications not just for environmental management, but for how companies approach innovation and long-term growth. The same pressures that once led to deferred maintenance have also shaped decisions about the innovation drought. A sharp decline in corporate research and development has quietly reshaped the American economy. The era when companies invested heavily in breakthrough ideas gave way to a model that treats R&D as an expense to be minimized, not a source of future growth. Since 1980, inflation-adjusted R&D spending by major corporations has fallen dramatically, with firms now allocating just a fraction of what they once did. This drop isn't a reflection of fewer opportunities or less need for innovation. It's a direct result of shareholder value theory, which rewards short-term financial performance over long-term investment. The shift is visible in the fate of legendary innovation labs. Xerox PARC, which developed the personal computer, graphical user interface, and Ethernet networking, was shuttered in the 1990s after shareholder pressure forced the parent company to prioritize dividend payouts. IBM, once famous for spending over 10% of revenue on research, gradually cut back as creative accounting and financial engineering became standard practice. Today, IBM's R&D investment hovers around 3.4% of revenue, and the company's RAND chart, once a symbol of technological ambition, now reflects years of incremental updates rather than bold leaps. As R&D budgets shrank, the nature of innovation changed. Patents, once a byproduct of genuine invention, became tools for blocking competitors and inflating valuations. Technology companies amassed vast portfolios of intellectual property, but the majority of these patents never led to real products. Apple's tens of thousands of patents protect its market position, but only a small percentage translate into commercial offerings. Pharmaceutical companies stretch patent lifespans through minor modifications, prioritizing monopoly profits over new treatments. According to recent audits, most software patents fail to result in shipped products, and companies now acquire patents primarily to impress investors rather than to launch new ideas. Short-term incentives also shape the fate of promising projects. At Procter & Gamble, a breakthrough water purification technology was shelved when activist investors demanded higher dividends. Despite the potential for enormous long-term returns, executives could not justify the 5-year development window to shareholders focused on quarterly results. The technology, with the capacity to transform global water access, remains unused. This pattern has played out across industries. Projects with transformative potential are routinely abandoned or delayed because their payoffs fall outside the time horizons that dominate boardroom thinking. Acquisitions have become another tool for stifling innovation. Tech giants routinely buy startups, not to integrate their ideas, but to neutralize competitive threats. Facebook and Google, for example, have acquired hundreds of companies over the past decade, shutting down most of their products and absorbing their teams. This approach, sometimes described as innovation taxidermy, rewards defensive maneuvers over genuine progress. Internal communications from major firms confirm that many acquisitions are explicitly intended to bury new technologies, rather than bring them to market. The consequences of this innovation drought reach beyond technology. As companies cut R&D, government labs and public funding have stepped in to fill the gap. More than 70% of foundational advances in artificial intelligence since 2020 have come from taxpayer-funded research, not corporate labs. The semiconductor industry relies heavily on government-backed initiatives for next-generation developments. Even in pharmaceuticals, where high research costs are often cited to justify prices, most new drug discoveries build on public science. Private firms increasingly focus on commercialization, leaving the riskier, exploratory work to the public sector. Some industries, however, have started to reverse course. The pharmaceutical sector, after years of stagnation, has seen firms like Merck and Moderna increase R&D spending, resulting in major breakthroughs that paid off quickly once products reached the market. Medical device makers now invest more in research than many tech firms, driven in part by regulatory frameworks that demand long-term thinking. In agriculture, companies like John Deere have committed to ambitious, multi-year development cycles, resulting in products that generate recurring revenue and lock in customer loyalty. International comparisons underscore the impact of different corporate models. Jurisdictions that emphasize stakeholder interests and patient capital, such as Germany and the Netherlands, have maintained higher levels of industrial R&D and outperformed in key sectors. Research from B Lab shows that companies adopting stakeholder-oriented governance structures are more likely to sustain innovation and deliver long-term value, even if they're quarterly. Results are less dramatic. The cumulative effect of these trends is a corporate landscape that struggles to deliver the kind of breakthrough advances that once defined American industry. As companies chase short-term rewards, the capacity for real innovation narrows, and the risks of stagnation grow. This environment not only limits growth, but also creates fertile ground for other problems, ones that can undermine trust and stability across the entire economy. Fraud epidemic. Fraud has become a persistent feature of the modern corporate landscape, driven by the same incentives that have reshaped business over the past few decades. As executive compensation became increasingly tied to share price, the pressure to deliver short-term results intensified. This environment encouraged not just aggressive accounting, but outright deception. The largest fraud cases of 2025 were not isolated incidents. They were symptoms of a wider system that rewards financial engineering over real performance. Revenue recognition manipulation is now the most common tactic. Companies book sales before products ship or stretch reporting periods to meet quarterly targets. Forensic accounting teams, using advanced data analysis, have found that the majority of major frauds in recent years relied on these methods. The drive to hit earnings forecasts turns minor adjustments into systemic schemes. In the case of Telia Company's Uzbekistan division, managers created fictitious contracts and customers to reach bonus thresholds. The fraud unraveled only after an analyst noticed discrepancies between office supply orders and reported subscriber numbers. Forensic audits revealed hundreds of millions in fabricated sales, all designed to meet executive incentive targets. Auditing, once a safeguard, has lost much of its deterrent power. Big Four firms now devote significantly less time to each audit than in previous decades, and the rise of checklist-based reviews has replaced deeper professional skepticism. A notable example came in 2025, when PwC was fined $3.35 million for breaches of auditor independence, highlighting how conflicts of interest persist. Auditors often rely on fees from consulting and non-audit services for the same clients, undermining their objectivity. Material errors in financial statements are routinely missed, and compliance has become a box-ticking exercise rather than a meaningful check on fraud. Business schools have normalized many of these tactics. Courses in earnings management teach future executives how to shift revenues across quarters, use reserves to smooth results, and adjust depreciation schedules to flatter profits. These practices occupy a gray area, technically legal until they cross a subjective line. The culture of aggressive interpretation is reinforced by the knowledge that every dollar in reported earnings can drive disproportionate increases in market valuation, justifying riskier behavior. Credit rating agencies also contribute to the problem. These firms earn fees from the companies they rate, creating incentives to inflate ratings. Internal memos from major agencies have shown analysts holding back on downgrades until new consulting contracts are secured. Structured finance products regularly receive high ratings when issuers purchase additional services. When a commercial mortgage fund rated AAA collapsed in 2025, it emerged that analysts had ignored due diligence reports showing a large share of properties were already underwater. Internal controls and regulatory oversight have not kept pace. Whistleblowers, once seen as a last line of defense, often face retaliation or find their concerns buried. Agency costs and weak internal controls make it easy for executives to override safeguards. Many firms now include confidentiality clauses in severance agreements, deterring employees from reporting misconduct. As a result, tips to regulators from industry insiders have declined, not because fraud has disappeared, but because the risks of speaking out have grown. The link between stock-based compensation and fraud is well documented. Companies with the highest equity incentives experience far more restatements and irregularities than those with traditional pay structures. A Federal Reserve study found that firms relying heavily on stock options misreport revenues at triple the rate of those using cash bonuses. The culture rewards executives who can deliver short-term pops in share price, even if it means bending or breaking the rules. At Wells Fargo, the push for sales targets led to widespread creation of fake accounts, with managers pocketing bonuses while the company's reputation suffered lasting damage. As traditional audits falter, outside analysts and short sellers have stepped in. Groups of independent investigators now use forensic methods, matching shipping manifests to reported revenues, analyzing utility bills at factories, and even tracking satellite imagery to uncover discrepancies. These networks have exposed billions in hidden liabilities, often identifying fraud well before official investigations begin. Machine learning and statistical tools like Benford's Law are now standard in fraud detection, scanning thousands of data points for unnatural patterns. In 2025 alone, these techniques flagged several major scandals that escaped conventional audits. The normalization of aggressive financial tactics has changed the attitudes of corporate insiders. Surveys show that a significant share of finance executives feel pressured to misrepresent financials each quarter, and many believe their competitors routinely cross ethical lines. This environment erodes trust, not just within companies, but between businesses and the public. As long as markets reward inflated results and the penalties for fraud remain limited, the incentives for deception persist. The consequences are clear: inflated stock prices, eroded trust, and significant losses for investors and employees when the truth finally emerges. Even as regulators and forensic accountants refine their detection tools, the cycle continues. But as trust in corporate reporting declines, a new force has begun to shape the marketplace, one that holds companies accountable in a different way. Customers fight back. Customers have become the most effective check on corporate behavior in 2025. As public trust in companies erodes, consumer activism has taken on new forms and gained real leverage. Boycotts, negative review campaigns, and viral social media movements now have the power to force rapid changes in corporate policy, hitting companies where it matters most: loyalty and reputation. The most visible shift is in how quickly coordinated consumer actions can reshape business decisions. Instead of relying on lawsuits or regulatory intervention, customers organize online, using platforms like review sites and social media to amplify their message. When a major outdoor retailer faced backlash for reducing repair warranties, thousands of negative reviews appeared within days. The company reversed course, reinstating its original lifetime repair program after seeing a sharp drop in sales and a surge in public criticism. This kind of direct feedback loop has become common, with companies monitoring review platforms and social channels as closely as financial statements. Review bombing has emerged as a powerful tool. When a brand is perceived as prioritizing shareholder value over customer satisfaction, coordinated negative reviews can quickly erode its public image and deter new buyers. In 2025, several consumer electronics brands saw their sales plummet after online activists targeted specific products with detailed complaints about declining quality and misleading marketing. The impact of these campaigns is amplified by their ability to go viral, with negative reviews spreading rapidly across platforms and prompting mainstream media coverage. Companies are learning that short-term cost-cutting or unpopular policy changes can result in immediate, measurable financial losses. Consumer loyalty is being redefined. Companies that invest in ethical practices and long-term relationships are rewarded with advocacy and repeat business. Patagonia's commitment to lifetime repairs and product transparency, for example, has generated significant resale revenue and strengthened its customer base. The brand's approach stands in contrast to competitors that chase quarterly gains at the expense of trust. B Corp and stakeholder-focused firms have seen similar benefits. Research shows that companies expanding their focus beyond shareholders consistently gain and retain customers, even when their profit margins are lower than industry averages. Subscription fatigue, once dismissed as a minor annoyance, now drives mass cancellations. Customers have grown wary of paywalls and recurring charges for features that were once standard. When a software company attempted to gate new AI tools behind an additional subscription, users responded by canceling in large numbers and voicing their frustration online. The resulting loss in long-term customer value far outweighed any short-term revenue boost. Companies are now rethinking subscription models, recognizing that customer resentment can spread quickly and damage brand loyalty. Millennials, in particular, have reshaped the market with their vote with your wallet mindset. According to recent research, they are far more likely than previous generations to boycott brands over ethical concerns and are willing to pay premiums for products with transparent supply chains. Their purchasing decisions have pressured major retailers to audit suppliers and remove harmful ingredients from store brands. Companies that adapt to these expectations often see more stable revenue streams, even if their profits grow more slowly than those of competitors focused solely on volume. The rise of de-influencing has also changed how products are evaluated. Social media creators now build large followings by documenting product failures and exposing misleading claims. Authenticity and transparency drive engagement, while user-generated reviews and product tests can make or break a brand. Outdoor brands that highlight durability and honest performance have gained millions of followers, while those caught exaggerating features see sales decline. Customers trust peer recommendations and warnings more than corporate marketing, shifting the balance of power away from traditional advertising. Direct-to-consumer models have further empowered customers. Platforms like Etsy and CrowdCow allow producers to connect directly with buyers, bypassing shareholder-driven intermediaries. Sellers retain a greater share of revenue, and buyers appreciate the transparency and value. Even large brands are being forced to respond, as consumers increasingly seek out alternatives that align with their values and reward ethical production. Luxury brands have responded differently, insulating themselves from quarterly pressures by focusing on craftsmanship and exclusivity. Companies like Hermès and Rolex invest in quality and limit production, maintaining customer loyalty and brand value over decades. Their long-term approach results in more stable performance, demonstrating that it is possible to thrive without constant cost-cutting or rapid expansion. Ultimately, these customer-driven changes reflect a deeper shift in how value is measured. Companies are rewriting customer lifetime value models to include advocacy, loyalty, and social impact, not just immediate sales. The most successful firms recognize that cultivating trust and long-term relationships generates more sustainable growth than extracting quick profits. This new calculus is forcing businesses to adapt or risk losing their most valuable asset, loyal customers. As customers reshape the rules of engagement, another group is quietly redefining the boundaries of corporate power from within. Workers strike differently. Inside the workplace, a different kind of resistance is taking shape, one that relies on subtle tactics rather than public confrontation. Employees are pushing back against shareholder-centric management by quietly withholding their expertise, slowing the transfer of knowledge, and following inefficient procedures to the letter. This isn't traditional labor unrest. It's a form of silent negotiation that leverages the value of institutional memory and day-to-day know-how. Quiet constraint has become common in 2025. Workers who have seen colleagues laid off after training their replacements now hold onto what they know. They skip documenting processes, avoid mentoring, and limit the sharing of best practices. A recent Deloitte survey found that a majority of mid-career professionals admit to hoarding expertise, hoping to maintain job security in an environment where loyalty is rarely rewarded. The result is a steady erosion of productivity that doesn't show up on a balance sheet, but costs companies billions each year in lost efficiency and missed opportunities. In technical roles, employees have developed new forms of resistance. Software engineers, for example, sometimes introduce redundant code or comply so rigidly with unrealistic deadlines that projects accumulate technical debt. Call center workers, bound by strict scripts, resolve fewer issues per call, not out of apathy, but as a response to systems that measure performance by the wrong metrics. Departments that install monitoring software often see productivity drop as workers focus on gaming the system rather than solving real problems. Work-to-rule actions have spread beyond unionized sectors. Employees in logistics, healthcare, and retail now perform every task exactly as written, refusing to take the shortcuts that once kept operations running smoothly. Pharmacists, for example, verify every prescription step by step after staffing cuts, resulting in long waits but perfect compliance. Nurses document every minor detail, overwhelming administrators with paperwork. These actions reduce output, but because workers are following official policy, they remain insulated from discipline. The consequences for employers are significant. At Southwest Airlines, a decision to cut training budgets led experienced ground crews to stop sharing undocumented methods for speeding up plane turnaround. New hires, lacking this tribal knowledge, struggled to keep up, and on-time performance suffered. The financial losses from delayed flights far exceeded the savings from reduced training. In manufacturing, companies that encourage knowledge sharing among veteran workers, such as Toyota, consistently outperform those that rely on rigid systems and frequent staff turnover. In many fields, employees have rediscovered a sense of craft pride as a form of quiet protest. Baristas spend extra time perfecting lattes, mechanics restore cars with meticulous care, and designers slow down to ensure quality. These acts aren't about inefficiency. They're about reclaiming control over work in environments dominated by efficiency targets and cost cutting. Customer satisfaction often rises in these cases, even as throughput drops. Companies that recognize and support this professional pride tend to see stronger loyalty and better long-term performance, while those that suppress it face higher turnover and lower engagement. The financial impact of disengagement is difficult to ignore. High turnover in knowledge industries now costs more than direct staffing budgets. Recruiting and onboarding a replacement for a single engineer can cost hundreds of thousands of dollars when productivity losses are included. Warehouses with high churn spend more on constant hiring than on training or development. Firms that avoid layoffs and invest in retention, like Costco, report substantially lower recruitment costs and stronger operational stability. Employee engagement is directly linked to company performance. S&P 500 firms with high engagement scores have outperformed their peers in recent years, while disengaged workforces are associated with more product defects and lower customer satisfaction. Some companies, such as Microsoft, have experimented with shorter workweeks, finding that the investment in employee well-being pays off in higher productivity and improved stock performance. This shift in thinking recognizes that a motivated workforce is not just a cost, but a source of competitive advantage. Where traditional unions have struggled, new forms of worker organization have emerged. Professional networks, both formal and informal, allow employees to share information about pay, working conditions, and management practices. In tech and creative industries, these networks have helped workers negotiate better terms and push back against exploitative practices. At the same time, companies are spending more on compliance and oversight as they try to keep pace with these underground movements. These developments have forced a reevaluation of how value is created and sustained within organizations. Leaders who embrace stakeholder-oriented governance, as seen in some B-Lab-certified companies, are finding that investing in employee voice and well-being leads to stronger long-term outcomes. Younger investors, too, are pushing for more robust environmental, social, and governance standards, recognizing that sustainable business practices depend on engaged, empowered workers. As companies grapple with the hidden costs of disengagement and silent resistance, they are beginning to confront another challenge, one that lies at the intersection of finance and the future security of millions of workers. The pension fund paradox. The paradox at the heart of American retirement security is that pension funds, institutions designed to ensure long-term financial health for millions, have often reinforced the very short-termism that undermines their own future returns. For years, these funds pressured companies for quick results, demanding higher dividends and aggressive cost-cutting to meet actuarial targets. Yet, the consequences of these demands have come full circle, with pension portfolios missing out on long-term growth as the companies they invest in sacrificed innovation and resilience for quarterly gains. The mechanics of this paradox are rooted in how pension funds set their expectations. Actuarial models often require annual returns of 7%, or more to keep future obligations funded. This creates a relentless pressure on fund managers to favor immediate payouts from portfolio companies, even when those companies would benefit from reinvesting in research, workforce development, or infrastructure. The result is a cycle where companies cut back on the very investments that drive sustainable growth, leaving pension funds exposed to underperformance over the long time horizons they actually need to manage. There are clear examples of how this short-term focus has backfired. When companies like Boeing pursued aggressive stock buybacks and layoffs to satisfy investor pressure, including that from pension funds, the immediate effect was a bump in share price. But over the following decade, weakened product pipelines and eroded institutional knowledge led to costly setbacks, ultimately reducing the value of those same pension fund holdings. The pressure for near-term results undermined the stability and growth that pensioners depend on for decades. Some pension funds have begun to recognize the limits of this approach. A few have shifted their strategies, moving away from quarterly performance reviews and toward longer-term benchmarks. The Texas Teachers' Retirement System, for example, made headlines by lengthening its investment time horizons and encouraging portfolio companies to prioritize multi-year R&D projects. Early results showed these holdings outperforming the fund's traditional investments, suggesting that patience can yield better returns than constant demands for immediate gains. While not all funds have adopted this approach, the shift signals a growing awareness that long-term value creation is more compatible with the mission of retirement security than the pursuit of short-term payouts. The issue is not just about investment horizons. Pension funds are large, diversified shareholders, so-called universal owners, with stakes in companies across entire industries and supply chains. When they push one company to squeeze suppliers or lay off workers, they may inadvertently harm other firms in their own portfolios. This interconnectedness has led some funds to reconsider how their actions ripple through the broader economy. By supporting stable, sustainable business practices, pension funds can help create more resilient companies and, in turn, more reliable long-term returns. Generational differences within pension fund leadership are also shaping this evolution. Younger trustees and beneficiaries increasingly advocate for sustainable investments and environmental, social, and governance (ESG) criteria, recognizing that long-term risks, such as climate change or workforce instability, can threaten portfolio performance. Research from the CFA Institute and recent fund surveys show that plans with a stronger focus on long-term, stakeholder-oriented strategies have outperformed peers that remain fixated on quarterly results. Some funds have looked to alternative models for inspiration. University endowments, like Yale's, have demonstrated the benefits of committing capital to a liquid, long-term assets, accepting short-term volatility in exchange for higher long-term growth. Corporate pension plans have started to adopt similar approaches, holding assets longer and evaluating performance over rolling 10-year windows. These strategies have shown that accepting temporary dips can lead to outsized gains, especially when investing in innovative or emerging sectors. The broader shift is visible in statements from business leadership groups. In 2019, the Business Roundtable redefined the purpose of a corporation to include responsibilities to employees, customers, and communities, not just shareholders. This change reflected growing recognition that sustainable value creation requires balancing the needs of multiple stakeholders over time. Pension funds, as some of the largest and most influential investors, play a central role in how these priorities are translated into corporate action. As the pension industry re-examines its assumptions and adapts to new realities, the impact is already being felt in boardrooms and executive suites. The pressure for quarterly results is no longer unchallenged. A new generation of leaders is emerging, questioning old doctrines and searching for better ways to align corporate CEOs who defected. A growing number of high-profile CEOs have begun to reject the doctrine of shareholder primacy, even as many of their peers continue to defend it. These executives, often coming from some of the world's largest companies, have started to question whether maximizing quarterly returns truly serves shareholders, employees, or the broader economy. Their shift is not driven by abstract theory, but by hard lessons learned from years of managing through crises, talent shortages, and public backlash. Paul Pullman, former CEO of Unilever, stands out as an early and vocal advocate for stakeholder capitalism. When he eliminated quarterly earnings guidance in 2009, Many investors were skeptical. Yet, under his leadership, Unilever's total shareholder return outpaced the S&P 500 over the next decade. Pullman's approach was rooted in a belief that focusing on long-term value, through sustainability, employee well-being, and product quality, would ultimately deliver better results. He argued that serving all stakeholders, not just shareholders, is the best way to ensure sustainable success. This stance was not universally popular among investors at first, but Unilever's performance provided tangible evidence that a broader approach could work. Other large firms have followed similar paths, sometimes after periods of instability. IBM, facing years of stagnation and declining morale, restructured its management incentives to reward innovation and long-term growth rather than just quarterly earnings. The company extended vesting periods for executive compensation and began tying bonuses to product development milestones and customer satisfaction metrics. Over time, IBM saw a rebound in patent filings and a reduction in costly turnover, suggesting that aligning leadership incentives with long-term goals can rebuild both innovation and trust. The 2019 Business Roundtable statement marked a significant turning point. Signed by 181 CEOs, including leaders from JP Morgan Chase, Apple, and Johnson & Johnson. The statement redefined the purpose of a corporation to include commitments to employees, customers, suppliers, and communities, not just shareholders. Jamie Dimon, chair of the Roundtable, described this as a necessary evolution, noting that the American dream is alive but fraying, and that companies must play a role in strengthening the social fabric. This was not just rhetoric. Companies that adopted these principles began to implement changes in board composition, risk oversight, and executive pay, reflecting a more balanced approach to value creation. The shift is visible in how these CEOs structure their own compensation. Leaders like Satya Nadella at Microsoft and Tim Cook at Apple have moved toward long-term equity vesting and multi-year performance metrics, in contrast to the quarterly vesting schedules that dominated the previous era. At MasterCard, the CEO's bonus is now tied to sustainability targets and employee engagement, not only financial results. These changes send a clear signal to both investors and employees. The company's future matters as much as its present. Experience often shapes these decisions. CEOs who have led through multiple economic cycles, or who have seen the effects of relentless cost-cutting and layoffs, describe a growing recognition that short-term gains can undermine long-term health. Some point to talent loss as a turning point. When key employees leave for competitors that offer more stability or purpose, the cost to innovation and culture becomes clear. In sectors like technology and healthcare, where feedback loops are short and the impact of disengagement is visible, leaders have been quicker to break from old models. The trend is not confined to one generation or industry. The Business Roundtable's signatories span a wide range of ages and sectors, from established manufacturers to fast-growing tech firms. What unites them is a willingness to challenge the assumption that shareholder value must always come first. Instead, they argue that balancing the interests of all stakeholders leads to more resilient, innovative, and ultimately profitable companies. This approach is gaining traction beyond the boardroom. Investors are starting to reward companies that demonstrate a commitment to long-term value, with patient capital now accounting for a growing share of institutional holdings. Firms that have adopted stakeholder-oriented strategies report higher employee retention, faster innovation cycles, and stronger performance during periods of market volatility. The data suggests that these CEOs are not just defying convention. They are building a new model that delivers results where it counts. As these leaders continue to refine their strategies, they are joined by a new wave of companies organized specifically around stakeholder principles. Their experience, especially during recent crises, offers a revealing comparison to traditional firms and signals a shift in what it means to be a successful business in today's economy. The B Corp surprise. The rise of B corporations has introduced a new standard for what it means to operate a successful business. B Corp, certified by the nonprofit B Lab, commit to balancing profit with responsibility to workers, customers, communities, and the environment. Unlike traditional corporations, they embed these commitments into their legal structure and undergo rigorous assessments of their entire operations, not just isolated projects. The B Corp movement now counts nearly 10,000 companies across more than 100 countries, signaling a shift among businesses seeking to address the shortcomings of shareholder primacy from within the system. B Corp have demonstrated notable resilience during periods of economic stress. While exact figures on every crisis vary, research from B Lab and industry surveys indicate that certified companies have outperformed traditional peers during downturns. Their advantage comes from structural choices. B Corp maintain higher cash reserves, invest in employee retention, and build strong relationships with customers and suppliers. These buffers mean that when markets falter, B Corp are less likely to resort to layoffs or drastic cost-cutting, and their customer loyalty tends to remain steady. In the wake of recent supply chain disruptions, B Corp, with diversified and ethical sourcing requirements, managed to keep operations running while competitors struggled to adapt. Investors and lenders have begun to recognize the lower risk profile associated with B Corp. Studies show that B Corp experience fewer bankruptcies and lower rates of fraud. This reputation for stability has translated into tangible benefits. B Corp often secure financing on more favorable terms, and some pension funds now allocate a greater share of their assets to stakeholder-oriented companies after seeing improved performance during recent market volatility. Venture capital has also flowed to B Corp-certified startups at higher valuations, as investors seek out businesses that can withstand shocks and maintain growth over the long term. Patagonia is frequently cited as a leading example of the B Corp approach in action. Rather than chasing short-term sales through aggressive discounting or rapid expansion, Patagonia has focused on product durability, environmental stewardship, and transparent business practices. Its resale and repair programs, which encourage customers to extend the life of their gear, have generated significant recurring revenue and built a loyal customer base. This strategy has forced competitors to reconsider their own models, but the systemic changes required for B Corp certification remain a barrier for many. The appeal of B Corp extends beyond customers. Workers are drawn to certified companies by the promise of meaningful work and greater job security. B Corp report higher rates of employee retention and engagement, with experienced staff staying longer and contributing to institutional knowledge that supports innovation. During industry downturns, B Corp are less likely to resort to layoffs, which further reinforces loyalty and operational stability. This culture of trust and shared purpose helps B Corp attract talent, even in competitive labor markets. Supply chain management is another area where B Corp stand apart. Certification requires companies to build ethical and resilient supplier networks, which has proven advantageous during logistics crises. B Corp have been able to shift to regional or alternative suppliers when disruptions occur, maintaining inventory and service levels while others face shortages. These long-term supplier relationships also create opportunities for collaboration and innovation that go beyond transactional contracts. Customer trust is a defining feature of the B Corp model. Surveys indicate that consumers are increasingly aware of B Corp certification and are willing to pay a premium for products and services from certified companies. The certification process includes audits of quality systems and transparency practices, which reduces the risk of product recalls and reputational damage. When safety or quality issues arise in the market, B Corp often see increased demand as customers seek out brands they perceive as more reliable and responsible. Legal protections distinguish B Corp from traditional corporations. Their charters explicitly allow directors to consider the interests of all stakeholders, shielding them from lawsuits by shareholders who might otherwise object to decisions that prioritize long-term value over immediate profit. This legal framework has been codified in 37 states, with several requiring boards to weigh stakeholder interests in governance. The growing adoption of these statutes reflects a broader shift in corporate law, providing safe harbors for companies that want to move beyond shareholder primacy. The influence of the B Corp movement is visible in unexpected industries, from construction to banking and even funeral services. Companies in diverse sectors have pursued certification to differentiate themselves, access new capital, and meet the demands of customers and clients seeking ethical partners. These trends suggest that stakeholder governance is not limited to consumer brands, but can be applied wherever businesses seek to build trust and resilience. As B Corp continue to set new benchmarks for performance and accountability, they serve as a proving ground for alternative models of capitalism. Their results have challenged assumptions about what drives long-term success and have encouraged a rethinking of risk, value, and responsibility. The next wave of change is being driven by new tools, ones that can measure and predict the impact of business decisions with a level of precision that was previously out of reach. Algorithmic accountability. Algorithmic accountability is reshaping how companies are evaluated and managed, shifting the focus from quarterly results to long-term value and risk. The rise of advanced machine learning and data analytics in the financial sector has made it possible to analyze factors that traditional accounting and human judgment often overlook. BlackRock, one of the world's largest asset managers, has integrated artificial intelligence into its investment processes, using systems that process a wide array of data, from energy usage in warehouses to turnover rates among mid-level managers. These algorithms do not rely on intuition or conventional wisdom. They scan for patterns and anomalies that signal deeper problems or hidden strengths. The impact of these tools is clear in how they change investment decisions. Quantitative models now flag companies that exhibit the hallmarks of short-term thinking. Excessive share buybacks, sharp cuts to R&D, or executive compensation structures that reward immediate gains over sustainable growth. When these signals appear, funds may reduce their positions or avoid investing altogether. Academic studies on algorithmic ESG integration show that such systems consistently identify risks that human analysts miss, particularly in areas like environmental compliance, supply chain stability, and workforce engagement. BlackRock's internal policy, for example, prioritizes investments where predictive models indicate a strong likelihood of long-term value creation, even if short-term results appear lackluster. The predictive power of these algorithms extends beyond financial statements and earnings reports. Alternative data sources have become central to risk assessment. Satellite imagery of factory parking lots, for instance, can reveal shifts in production before they show up in official numbers. Natural language processing tools analyze the tone and content of earnings calls, flagging inconsistencies or signs of stress in executive communication. In one documented case, algorithms detected a pattern of jargon-heavy responses from a major manufacturer's CEO, a signal that preceded a significant product recall. These unconventional indicators often provide early warnings of trouble, prompting investors to act before problems become public. Employee sentiment analysis is another area where algorithmic accountability is changing corporate oversight. By analyzing anonymized communication patterns, algorithms can measure collaboration, engagement, and even looming morale issues. Funds increasingly use this information to evaluate management quality and the likelihood of operational disruptions. Companies with high employee engagement scores, as measured through these digital footprints, tend to outperform those where communication is fragmented or hierarchical. This shift in monitoring influences not only investment, but also how companies structure their internal policies, with more firms focusing on workforce development and retention as a way to improve their standing with data-driven investors. The use of predictive analytics has also influenced corporate governance. Firms that adopt these tools are more likely to extend executive vesting periods, tie bonuses to long-term performance metrics, and invest in training programs that might not pay off for several years. Procurement decisions, once driven by the lowest bid, now incorporate algorithmic assessments of supplier reliability and risk exposure. This data-driven approach encourages a departure from the narrow focus on quarterly earnings and instead supports strategies that build resilience and adaptability. Former quantitative analysts have played a key role in this transition, moving from hedge funds to corporate sustainability teams and institutional investors. Their models demonstrate that investments in ethical supply chains, emissions reduction, and employee well-being correlate with lower volatility and stronger long-term returns. These findings have persuaded large asset managers to demand more transparency and better data from the companies they hold, not as a matter of ethics, but because the numbers show clear financial benefits. For example, BlackRock's risk assessment models now incorporate climate risk and supply chain integrity as core inputs, driving capital toward companies better positioned for long-term success. The evidence from these systems is difficult for executives and boards to ignore. Quantitative models show that stakeholder-focused companies experience less volatility during market shocks and generate higher compound returns over time. They reveal that activist campaigns focused solely on short-term gains often erode value, while investments in people, innovation, and sustainability pay off in the long run. As more firms adopt algorithmic accountability, the shortcomings of shareholder value theory become increasingly apparent, not through ideology, but through empirical results. This transformation in how companies are measured and managed is already changing the expectations placed on corporate leaders. The next generation of executives is emerging in a landscape where data, transparency, and long-term thinking carry more weight than ever before. The Gen Z takeover. A new generation of leaders is quietly reshaping the corporate landscape. The arrival of Gen Z executives and fund managers marks a break from the conventions that defined American business for decades. They are digital natives, comfortable managing remote teams and flexible work arrangements, and they prioritize work-life balance as a core value rather than a perk. Their approach to leadership stands in sharp contrast to the traditional, in-office culture that dominated boardrooms for years. Gen Z's comfort with technology and openness to new working styles have accelerated the adoption of distributed workforces, and their preference for collaboration over hierarchy is now shaping how companies operate from the inside out. This generational shift isn't just about technology or flexibility. Gen Z leaders are challenging the long-held belief that experience alone should dictate who sits at the decision-making table. In many industries, the old model that rewarded tenure and institutional memory is being replaced by a search for fresh perspectives and adaptive intelligence. Companies are hiring and promoting younger executives who bring not just technical skills, but also a willingness to question established practices and experiment with new ideas. The result is a more diverse leadership pipeline, with greater representation of women, people of color, and professionals from non-traditional backgrounds. This diversity of thought is increasingly seen as an asset for navigating complex and rapidly changing markets. The influence of Gen Z is visible in the way companies measure and report success. Rather than focusing solely on short-term financial metrics, many organizations now adopt integrated reporting frameworks that align with standards set by groups like the Sustainability Accounting Standards Board, SASB. These frameworks require companies to disclose not just profits, but also environmental impact, workforce well-being, and governance practices. Younger executives and fund managers have been instrumental in pushing for this broader approach, using their influence as investors and board members to demand more transparency and accountability. According to research from the CFA Institute, younger fund managers are more likely to support ESG proposals and vote for policies that prioritize long-term value creation over immediate returns. This change in priorities is not limited to internal operations. Gen Z leaders are reshaping how companies interact with investors, customers, and suppliers. They are more likely to engage in open dialogue with stakeholders, invite feedback, and respond quickly to concerns about ethics, sustainability, or social impact. Some firms have adopted regular stakeholder meetings, where employees, customers, and community representatives can raise issues directly with executive teams. These practices reflect a belief that trust, reputation, and social license are as important to long-term success as quarterly earnings. In practice, the Gen Z approach to management often means flattening hierarchies, encouraging cross-functional collaboration, and rewarding skills and results over tenure. Career paths are less linear, with employees moving between roles and departments based on project needs and personal growth rather than a rigid ladder of promotions. This environment values adaptability and continuous learning, making it easier for companies to pivot in response to new challenges. It also helps attract and retain talent in a competitive labor market, as employees see opportunities for advancement and development without having to wait years for a promotion. The impact of Gen Z leadership is especially pronounced in industries undergoing rapid transformation, such as technology, renewable energy, and marketing. In these sectors, young executives have shown a willingness to take risks, iterate quickly, and treat failure as a learning opportunity rather than a setback. They are less attached to legacy systems and more open to experimenting with new business models, which has enabled some firms to outpace older competitors still debating their first major pivot. At the same time, companies that cling to traditional hierarchies and outdated assumptions about experience are losing ground, both in terms of market share and their ability to attract top talent. Gen Z's influence is also felt in the investor community, where younger fund managers are leveraging their roles to advocate for stakeholder-oriented governance and sustainable business practices. They are more likely to support shareholder resolutions on climate risk, diversity, and ethical supply chains, and they use their voting power to pressure companies into adopting longer-term strategies. This shift has begun to change the dynamics of annual meetings and proxy battles, as younger investors join forces with established institutions to demand greater accountability and forward-thinking leadership. The rise of Gen Z leaders signals a broader rethinking of what it means to build and sustain a successful company. Their willingness to question the status quo and prioritize long-term resilience over short-term gains has set new expectations for corporate behavior. As these new leaders continue to gain influence, they are not just changing the tone in the boardroom. They are redefining the rules of engagement for investors, employees, and competitors alike. This new reality is already having consequences for how companies respond to outside pressure. The tactics of those demanding change from the outside are evolving just as rapidly as the leadership inside. The new corporate raiders. A new generation of activist investors has emerged, challenging the legacy of the corporate raiders who once dominated headlines. Rather than demanding mass layoffs and aggressive buybacks, these investors focus on pushing companies towards stakeholder-oriented models. Their approach is rooted in the belief that long-term value comes from investing in employees, customers, and resilient operations, not just from cutting costs to meet quarterly targets. One of the most visible examples is the campaign led by Engine No. 1 at ExxonMobil. By building alliances with pension funds and emphasizing the financial risks of climate inaction, Engine No. 1 secured board seats and pressed for a shift in Exxon's long-term strategy. The result was a notable redirection of capital toward clean energy and a renewed focus on operational sustainability. This wasn't a moral crusade. It was a calculated argument that addressing environmental risks would protect and grow shareholder value over time. The Exxon case demonstrated that stakeholder-focused activism can drive meaningful change at even the largest and most traditional corporations. These investors often look for opportunities to partner with employees and other stakeholders. When activist funds targeted companies like Danone, they did so by highlighting how sustainable supply chains and employee engagement could reduce risk and foster innovation. The campaigns weren't about extracting short-term gains. They were about demonstrating that resilient, well-governed companies outperform their peers in the long run. This approach has led to alliances that would have seemed unlikely in the past, such as unions supporting activist campaigns that include commitments to job security and workforce investment. The new playbook relies on engagement and data. Activists use alternative metrics, like employee retention, supply chain resilience, and carbon intensity, alongside traditional financial measures. They present their cases to other shareholders, not by appealing to ethics, but by showing how these factors correlate with reduced volatility and stronger returns. Academic studies and industry research have reinforced their claims, showing that companies with strong ESG practices are less likely to face regulatory fines, operational disruptions, or reputational crises. Compensation structures for these new raiders reflect their long-term perspective. Unlike traditional activist funds that focus on rapid returns, stakeholder-oriented funds tie their fees and bonuses to performance over several years. Some funds even link compensation to sustainability milestones or improvements in workforce metrics, aligning manager incentives with lasting company health. Pension funds and institutional investors, eager to avoid the boom and bust cycles of past decades, have started to allocate more capital to these patient strategies. The outcomes are measurable. Companies targeted by stakeholder activists have shown increases in patent filings, higher employee engagement, and improved customer satisfaction compared to those subject to traditional cost-cutting campaigns. In several cases, activist interventions have led to board seats for operational or sustainability experts, rather than just financial engineers. The result is a shift in boardroom conversations, with greater attention paid to long-term risk management and value creation. Unions and labor groups, once wary of activist investors, now sometimes find common ground with those who advocate for stronger workplace protections and investment in training. These alliances have produced tangible changes, from improved safety protocols in logistics firms to expanded family benefits in service industries. The willingness of stakeholder activists to work with employees, rather than against them, has made it harder for companies to dismiss these campaigns as hostile or purely self-interested. Traditional activist tactics, quick asset sales, leveraged buyouts, and publicity stunts have lost much of their effectiveness. Markets now reward companies that can demonstrate sustainable growth and resilience, while punishing those that rely on short-term financial engineering. The new breed of corporate raider uses data and coalition building to make their case, making it increasingly difficult for boards to ignore their proposals. This evolution in investor strategy has not gone unnoticed by corporate leaders and legal advisors. As stakeholder activism gains traction, companies are rethinking how they define fiduciary duty and manage risk. Boardrooms are beginning to ask whether the old rules still apply, or if a broader interpretation of corporate purpose is now required to stay competitive. The answer to that question is being shaped not just by investors, but by changes in the legal revolution. Legal frameworks are undergoing a fundamental transformation, quietly redrawing the boundaries of corporate responsibility. The old understanding, shaped by the 1919 Dodge versus Ford decision, long held that shareholder interests should take precedence in boardrooms. Yet, the ruling itself was more nuanced than its legacy suggests. While the court sided with minority shareholders seeking dividends, it also reaffirmed the business judgment rule, granting directors latitude to make decisions they believed would benefit the corporation, even if those choices didn't maximize immediate returns. Over time, however, this precedent was interpreted narrowly, fueling the rise of shareholder primacy as a near-absolute standard. The past few years have seen a reversal of this trend. Rather than clinging to a doctrine that prioritizes short-term stock performance above all else, courts and legislatures have started to clarify that directors may, and sometimes must, consider the interests of a broader set of stakeholders. 37 states now have statutes that explicitly authorize or require companies to factor in the well-being of employees, communities, and the environment alongside shareholder interests. Benefit corporation laws, now widespread, provide legal cover for boards that choose to invest in long-term resilience rather than immediate payouts. Corporate leaders can point to these statutes when defending decisions that may depress short-term profits but support lasting value. This legal evolution has practical consequences. Directors today face growing scrutiny over how they weigh risks that extend beyond conventional financial metrics. When companies ignore workforce development, environmental impacts, or supply chain vulnerabilities, they can now be held accountable not just in the court of public opinion, but in actual courtrooms. Recent years have seen a marked increase in shareholder and derivative lawsuits that cite failures to address long-term risks as breaches of fiduciary duty. Plaintiffs' attorneys have shifted their focus, targeting not just missed earnings, but also lapses in areas like climate risk, labor relations, and community impact. Settlements and boardroom shakeups increasingly follow cases where directors failed to document their consideration of these broader factors. The composition of corporate boards reflects this shift. Companies are appointing directors with backgrounds in labor relations, sustainability, and public policy, roles that would have been rare a decade ago. Proxy advisors and institutional investors are pushing for these changes, arguing that boards need expertise beyond finance and operations to navigate today's risks. Data now shows that companies with directors skilled in ESG issues are less likely to face costly litigation and perform better over multi-year periods. Board minutes and compliance records increasingly include detailed discussions of stakeholder impacts, not just financial projections. Delaware, long the default for corporate charters, has seen its dominance challenged as other states move faster to update their legal codes. While Delaware courts have gradually recognized the legitimacy of stakeholder considerations, many companies now incorporate in states with clear benefit corporation protections. This migration reflects a broader recognition that the legal environment must keep pace with evolving expectations about corporate purpose. The trend is not limited to the United States. Courts in the UK and Australia have interpreted existing fiduciary duties to require directors to consider environmental and social risks, even without new statutes. Multinational companies must now navigate a patchwork of legal standards that increasingly converge on the principle that long-term value creation means looking beyond quarterly earnings. Settlements over issues like supply chain labor practices and environmental stewardship are setting precedents that ripple across borders. Corporate law firms have responded by advising clients to document stakeholder considerations in every major decision. Internal memos from leading firms now warn that ignoring these factors can expose directors to personal liability. Templates for board minutes include prompts to discuss employee retention, community relations, and environmental risks before approving major expenditures or dividends. What began as a defensive legal strategy has become embedded in routine governance. This shift is, in many ways, a correction of the misinterpretation of Dodge versus Ford. The original decision did not mandate shareholder primacy, but it was read that way for decades. Modern courts and legislatures are now clarifying that true fiduciary duty requires considering all factors that affect the corporation's long-term prospects, including those that touch employees, customers, and the wider community. Institutional investors, too, have adjusted their expectations. Pension funds and asset managers that once pushed for relentless focus on shareholder returns now demand evidence that companies are managing broader risks. Voting records reveal that major funds increasingly oppose directors who fail to address workforce issues or environmental threats. The legal system, once a barrier to stakeholder governance, has become a lever for aligning investor interests with broader societal needs. With these legal changes, compliance departments now track stakeholder metrics with the same rigor as financial controls. Public disclosures reference not only financial results, but also risks and opportunities related to employees, customers, and the environment. The result is a new landscape for corporate accountability, one where decisions are measured against a wider range of impacts, and where the law supports a more expansive definition of value. As this legal revolution takes root, the conversation inside companies is changing. Boards and executives are forced to look beyond the traditional numbers on income statements and consider which metrics truly predict lasting performance. The better numbers. Financial statements alone no longer capture the full picture of what makes a company successful in 2025. As businesses have shifted away from a narrow focus on quarterly earnings, a new set of metrics has emerged that better reflect a company's true health and long-term prospects. The most forward-looking firms now pay close attention to employee satisfaction, customer lifetime value, and supply chain resilience, three non-financial indicators that have proven to be more predictive of sustainable performance than traditional accounting measures. Employee satisfaction is increasingly recognized as a leading indicator of company success. Firms that track and act on employee feedback see lower turnover, higher productivity, and greater innovation. Research from Wharton and other institutions has shown that companies in the top quartile for worker satisfaction consistently outperform those that neglect workplace culture. The logic is straightforward. When employees feel valued and supported, they create better products, deliver stronger service, and help build a reputation that attracts both customers and talent. This effect compounds over time, making employee sentiment a critical input for long-term planning. Customer metrics have also evolved. Instead of relying on basic satisfaction surveys or short-term sales data, companies now measure the depth and duration of customer relationships. Customer lifetime value, for example, captures not just how much a customer spends, but how likely they are to remain loyal and recommend the brand to others. Retailers like Nordstrom monitor the share of a customer's purchases that come from their stores, while technology firms look at how many products and services a household uses within their ecosystem. These metrics help explain why some companies can thrive with lower margins. The loyalty and advocacy of long-term customers create a stable revenue base that supports ongoing investment and growth. Supply chain resilience has become a central concern, especially after recent disruptions exposed the risks of relying on single suppliers or just-in-time inventory systems. Companies that diversify their suppliers and build flexibility into their logistics networks are better able to withstand shocks and maintain operations during crises. Toyota's strategy of sourcing components from multiple suppliers allowed it to keep production running during global chip shortages, while firms with less resilient supply chains faced costly delays and lost market share. Analysts now reward companies that can demonstrate robust supply chain management and penalize those that leave themselves exposed to single points of failure. Traditional accounting standards, such as GAAP, have struggled to keep pace with these changes. They often fail to account for intangible assets like brand reputation, intellectual property, and human capital. As a result, the official balance sheet can dramatically understate the value that companies create through innovation, employee development, and customer loyalty. For example, when Microsoft acquired Activism, most of the purchase price was attributed to assets that standard accounting frameworks barely capture. intellectual property, talent, and brand equity. This disconnect between what is measured and what actually drives value has led to calls for new accounting frameworks that better reflect the realities of modern business. Investors have taken notice. Asset managers and pension funds are increasingly integrating these non-financial metrics into their models, recognizing that factors like employee engagement and supply chain strength are essential for long-term returns. Some investment firms have developed proprietary models that weigh talent retention, patent quality, and innovation pipelines alongside traditional financial data. These approaches have outperformed older models during periods of volatility, supporting the case for a broader view of corporate value. The demand for better numbers has also fueled a shift in how companies report their performance. Many now supplement financial statements with integrated reports that include data on environmental impact, workforce well-being, and customer engagement. This approach provides a more comprehensive view of a company's strengths and vulnerabilities, giving investors and stakeholders a clearer sense of what drives sustainable growth. The adoption of these new metrics has started to reshape investor behavior. As confidence grows in the predictive power of employee satisfaction, customer loyalty, and supply chain resilience, investors have become more willing to hold onto quality companies for longer periods. The average holding period for stocks has begun to lengthen, reflecting a renewed emphasis on patient capital and long-term value creation. The shift toward better numbers has not only changed how companies are managed and valued, it has also begun to separate the winners from the laggards. Firms that continue to rely solely on backward-looking financial metrics are increasingly viewed as risky and outdated, while those that embrace a broader set of indicators are rewarded with investor trust and market premiums. This trend is quietly transforming the corporate landscape, as more organizations realize that sustainable success depends on measuring what truly matters. These changes set the stage for a broader movement inside the business world. As new metrics gain traction and reshape both management and investment decisions, the underlying philosophy of corporate purpose is being rewritten, often without fanfare, but with profound consequences for how companies operate and compete. The momentum behind stakeholder governance is steadily increasing, with more companies adopting practices that look beyond short-term shareholder returns. Recent years have seen a noticeable shift in board priorities, as directors and executives respond to mounting evidence that ethical business conduct and long-term value creation can strengthen resilience and performance. Companies such as Patagonia and Costco, known for paying living wages and investing in their workforce, have consistently outperformed peers during periods of economic instability. While critics caution that broadening a company's focus may create challenges in balancing competing interests, research suggests that stakeholder-oriented firms experience fewer bankruptcies and greater stability. As legal frameworks and investor expectations evolve, the case for stakeholder governance is supported by growing data and real-world outcomes. The future of corporate success appears increasingly tied to the ability to deliver value for employees, customers, and communities.